Hi, welcome to class 26. Class 26 is about profit and loss statement. This is one of the financial statement I have discussed in the previous chapter. I told you the definition and the use of the profit and loss statement, right? So in general, I also told you that it is the balance sheet which is covered first, but in generally accounting classes. But in this course, we are going to cover profit and loss statement first because I have been telling you about one thing that businesses is all about making revenue and posting profit, reinvesting that profit so the businesses can grow, and that's how you make money into stock market. So to make it just interesting and easy, and since many people think that getting into financial statement and learning them is little tedious task, it's just an attempt to make it more interesting. Okay. Another thing, see every chapter in fundamental analysis should be very updated. This is what I feel like. Obviously when you have some theoretical part where you must know that how exactly a sheet should look like, how a profit and loss statement should look like, then what we will do that we will divide all these three chapters into two parts. One where we will see how exactly a profit and loss statement look like, and another is where we will see profit and loss statement of different companies on money control and screener.in. So those will be the latest example. So it doesn't matter you are buying this course today or after 6 months or whomsoever is doing, probably this is one content you will find always fixed. But let's say after 6 months when you come back, and since you have the excess of 1 year, you will see the second portion of the profit and loss statement is changed, because I want to keep that content very fresh and always want to show you a real example so that it also help you do some research with the latest data and also relate it with your own examples also. So we will also, so again this class will be divided into two parts. This is part one where we will just focus on this sheet and learn about some basic concepts, that how exactly a profit and loss statement look like and what all are different terminologies of a profit and loss statement. Then also that why we have divided so many different segments to report profit at different level, why we are defining the profit at different levels. What is that level is something what I have highlighted in this yellow color, right? And in the second portion we will directly jump to companies profit and loss statement, compare to, and then see that which company's profit and loss statement is looking better, or what exactly is the information it is giving me, right? So let's understand how a profit and loss statement look like. So very first term which you come across is revenue, right? Now whatever the product you are making, you have to sell it, and when you sell it you generate revenue. In service industry you provide services, for that you bill your client pays, that is called your revenue, right? So revenue is something which you have to always keep in on the head. Like, okay, so I made 1 crore revenue for my shoe manufacturing company, right? So 1 crore revenue is something which you understand now, that total number of shoes which you have sold, you generated a revenue of 1 crore. Now to make these shoes, you obviously needs other goods to manufacture these shoes. So the very first thing which you subtract is called cost of goods sold. Let's say in this case cost of goods sold is 30 lakh rupees. So at first level you have to understand what is the gross profit you are making in your main frontline product, or summation of all the frontline products. So one important key term which comes here is gross profit, which you have to remember. So gross profit is something which is just subtraction of revenue minus cost of good sold. Then obviously when you are manufacturing shoes, you have to market it, you have to hire salespeople, and so many other operational expenses, branding expenses can come. So other operating expenses has to be divided also, because at the end of the day this is not something which you are going to be with the company, that has to be subtracted, not divided. So let's say I have just taken two operational expenses for the sake of keeping it simple. One is, let's say, the branding cost, and another is marketing cost, sales and marketing cost. So 5 lakh is the branding cost of that, for which we have, let's say, given it to one of the brand ambassador, and 15 lakh is paid for all the sales and marketing effort. So when you subtract your operational expenses from your gross profit, what comes to you is EBITDA, EBITDA. Now the full form of EBITDA is very simple, and it is earning before interest, tax, depreciation and amortization. Now here I will stop for a minute and understand all the terms which has been used into EBITDA. So earning is okay, before is okay, earning is something which you understand. Interest. Now, how does company raise fund? Either through raising it through debt or by inviting people to become shareholder. So debt or equity, right? So interest is, again, you pay interest, I pay interest when we take loan. This is the same interest in EBITDA. Taxes. You have to pay taxes. When you make money, you have to pay taxes to the government. This is that taxes. Depreciation. You buy a car. You buy a car in 15 lakh rupee. After 5 years, when you go and try to sell it in second hand market, do you think you will be able to fetch it at 15 lakh rupee? No. You might get after 10 years 2 or 3 lakh rupees. Rest of the value of that car get depreciated. So every company have certain assets which gets depreciated. Machineries get depreciated. Land is a fixed cost. It don't get depreciated, right? Maybe when you go to a company which is IT company, there you will see depreciation cost is not that high the way it is for manufacturing company, because manufacturing companies will have machine will get obsolete, new machine needs to be bought time to time, and older machine values will get depreciated. So depreciation is something which you have to always keep in account. So depreciation is that. Amortization is, interest is one part, but when you take loan, amortization is something which a common people like you and me can understand very easily. The reason being, we all of us, most of us, when we take loan, let's say it can be your house loan, your car loan, you don't just end up paying interest per month. What you pay is an EMI. Amortization is that fixed amount of sum which you pay to repay your loan, which includes some part of the principal and some part of the interest also. So amortization is that part when you talk about EBITDA. So at EBITDA level also, many people try to see the efficiency of a firm. Net profit is something which I have been highlighting all through course, that you have to always look at how much profit this company is making. In the other quantitative chapters, I have shown you that only the net profit which will going to push all the growth within that company. This is what you have to take in consideration to show that what kind of power of compounding can take effect, so that it will become one of the greatest company or the biggest company one day. But then amortization, interest, these all are different variables. Sometime one company may have loan which is very high interest loan. However, another company is not having that high interest loan, right? This can be possible. Some people get cheaper loan, some people get expensive loan. One of the company which is very established in comparison with the new company will get cheaper loan for sure. Now that can change in future, right? And that's why if you really want to see that how well one company is converting its overall sales into profit, is something which you can do and see at EBITDA level as well. Some companies will have huge portion of loan, but then they are making good profit, and that's why they are paying off loan. And one day you will see that they are loan free, and suddenly this company is having a lot of cash with them. So that's why it becomes very important that when you have to see the efficiency of different companies at different level, you have to compare. In certain sectors, you may feel like just comparing the net profit and the percentage of return, what net profit is actually against the capital employed. And in certain cases, you may want to see the EBITDA also. And that's why it is important that you understand EBITDA. So in this case, EBITDA here is 5 lakh rupees. I know it will not make much sense at this point of time, but you have to remember it. That's how learning happens. Few concepts we have to remember it. So you just remember it in this class. In next class, when we will compare the profit and loss statement of two companies, you will see that it's making sense, the theory which I'm talking to you right now. Again, coming back to this sheet, depreciation, now I have to factor in. So in this company, let's say I have taken a depreciation of the whole asset. Let's say that asset cost is around 2 crore and it is depreciating by certain rate, and that at that rate it got depreciated by 5 lakh rupee. Let's say in this case I have kept amortization as 0. Then you have EBIT, right? See, standalone, when you are looking at the balance profit and loss statement, you will see that okay, if interest this company is paying, this must be changing into the balance sheet, because balance sheet will have your debt and your equity portion. We will learn about that in future, but at this point of time when we are learning the profit and loss statement, we have taken one example. In that example we have taken amortization as 0, which means company has taken loan but only paying the interest, and they have a term and condition where at any point of time they will shift their liability from one place to debt to the asset side, where they will pull off money from whatever the retained earning they have and pay off all the debt at a time. So that kind of situation it is here in this example, right? So amortization is 0. All I was trying to do is basically trying to defend why I have kept amortization as 0, because it was important for me to highlight and tell you that you will find this factor as 0 in many of the balance sheet, because this is how your loan is different from the business loans, right? Then you have EBIT. So once you have subtracted the depreciation and amortization, obviously this D and A is gone, and what is left is EBIT. I have subtracted this 50,000, 5 lakh rupees from 50 lakh rupees, and it comes down to 4,50,000 rupees, right? Then obviously, as I said, the company has taken loan and it is paying in the form of interest right now. So we will subtract interest as well. Now, once you have subtracted the interest, is come profit before tax. Till this time you have not paid tax. Taxes will be only paid when you have shown your depreciation, amortization, interest rate, and everything which was the expenses incurred while doing or making the revenue. Then only government tell you that now you give me the taxes. Let's say the rate at which you have to pay the tax is 30%. So 30% of 35 lakh rupees is 10 lakh 50,000. What is left is 24 lakh 50,000 rupees as the profit. So what you see that in this format, you have to check companies obviously at different levels. So there will be a significance of net profit, because at the end of the day you have to pay the tax, and then only you will move forward. So once you have paid the tax, then only you will come to know that okay, my company which worth this much is making this much of return after tax. So there will be a significance to compare companies at all the level, and it will depend that which two companies from one sector you are comparing. Some companies may be very heavy debt company. So here comparing them at EBIT level will be very, very important, right? Because most of them will have huge interest to pay, right? So before paying interest, how efficient one company was in comparison with the other company in the same sector is something which you can see at EBIT level, because from total revenue you can always find out the percentage, right? So here what I can say that at EBITDA level the percentage is 50% for the gross revenue. However, when it comes down to net profit, it is coming at 24.5%. Okay, without confusing you much, all I want you to remember this format. Okay, some concept, yes, I know this course is more of a practical oriented where we try to do things and learn. However, few concepts I ask you to remember, to memorize. This is one of them, that please remember this format. Don't ask me for this Excel sheet. You rather make one, then only you will remember that how exactly a profit and loss statement should look like, what should be the sequencing, right? So let's move to the part 2 of profit and loss statement, where we will compare profit and loss statement of few companies and also learn about one important concept, standalone and consolidated. We'll start the chapter with these two concepts. Thank you.